Dr. Babasaheb Ambedkar Open University.
Hello dear friends, welcome here in this course of Fundamentals of Financial Accounting. As since last many lectures we are discussing different topics regarding the fundamentals of financial accounting. So here in this particular video lectures we are going to discuss about the depreciation. It is very good important terminology so far as accounting is concerned. Depreciation is all about the amount of assets has been utilized by the organization or it has been utilized in the company. So the valuation of the assets gradually decreases, or you can say the efficiency of the assets has been gradually decreases. So when you are actually purchasing an assets, at that point of time the valuation of assets is very huge, and that assets amount cannot be utilized in 1 year. So instead of the assets valuation were actually write off in the 1 year against the 1 year revenue, it is not accountability or it is not a justification also. So that is why we need to identify the how much amount of proportionate value of the assets can be write off every year against the income or against your revenue. That is considered as a depreciation. So the depreciation, it means the amount of assets actually utilized in specific year, or it can be said the efficiency of the assets may be reduced in the next year. The amount of reduction would be considered as a depreciation. So this is what all about we are going to discuss in this particular unit, or this unit will be vary in two particular video lectures. First is depreciation 1 and then we'll discuss depreciation 2 in the next video lecture also. Here we are going to discuss the depreciation, specifically straight line method. Well, what are the key takeaways? First is meaning of the depreciation, then characteristics of the depreciation, primary causes of the depreciation, what are the main objectives of the depreciation, factors determining for the depreciation, specifically the method which we are going to discuss in this particular unit, that is SLM, straight line method, and at last we will discuss the illustration also. Fine. Now here the meaning of the depreciation. What is all about the depreciation? As I already briefed out you, the depreciation is all about it's an accounting terminology. Accounting method is actually adopted to identify the assets reduction due to the usage of the assets in the specific year for generating a revenue. So now the depreciation is actually a kind of an accounting method used to allocate the cost of the tangible assets, correct? So depreciation is actually calculated only on tangible assets. So that's why we need to identify the what amount of the cost of the tangible assets actually identified and it has been over in useful life. Suppose if you purchase a plant or a machinery or something like that, and you identified that this plant and machinery cost of rupees 5 lakh, and this machinery is actually used in this particular plant or in this particular business for next 15 years. So ultimately the cost of the machinery which we identified, it is 5 lakh rupees, that is 5 lakh rupees of the machinery. Then it is a tangible assets, plant and machinery, it's tangible assets. Over its useful life we identified it's 15 years. So these assets will be actually utilized for 15 years. So these two informations which we are already identified. Then rather than recognizing the entire cost of an assets in the 1 year, it is purchased. So I told you that if you are going to write off this 5 lakh against in 1 year against the revenue, it would not be proper accounting transactions. Why? Because of the assets will be utilized in this business for at least next 15 years. So the whole 5 lakh rupees cannot be debited as a expenses or as a loss or as a part of the amount of cost can be deducted against the revenue, because that assets is been utilized in the business for longer period. So businesses spread the expenses over the years of asset expected to be used. So how many years it will be used? For a 15 years. So 5 lakh rupees will be actually distributed or vary for the next 15 years, and every year the amount of depreciation will be deducted. So, if you are going to find out the per year amount reduction, you can clearly distribute it, that 5 lakh divided by 15 years, whatever the answer you would get from it, every year it has been deducted from the profit and loss account. That amount which is deducted from the profit and loss account is considered as a depreciation. This is what all about the depreciation. So, there are so many methods. This is one of the simplest method how you can calculate the depreciation, and the depreciation can be easily straight away calculated. There are some other factors also affecting in this case, but I just want to explain what is depreciation. That is why I am taking very simple example. Now, these accounting practices are there to the matching of principle which states that expenses must be matched the revenues that help generate during the same accounting period. Again, which was already briefed out at the time of the introduction of the chapter. You need to matching your expenses and revenues which are actually occurred in the same year, and that is why instead of the debited 5 lakh rupees which are actually not an expenses for the particular 1 year, but it has been actually spread out the expenses for the next 15 years. So, that is why that the amount of expenses should be matched where the revenue is actually generated during the same accounting period. And that is why the revenue which you are actually earned, the same year expenses or a cost price of the asset should be deducted, and that is why we identified the depreciation of the asset has to be charged and that has to be debited. Then that calculation needs to be understood. That is why this is the first what is depreciation that we try to understand. Now, here the next is characteristics of depreciation. The depreciation characteristics are very simple. Since first of all you need to identify the accounting scope and nature. So, automatically the understanding is that accounting scope is actually identified on the fixed assets. So, we need to focus, the depreciation is charged on fixed assets. So, that is why we need to focus on fixed assets only. So, we have to identify the only tangible fixed assets. There are some intangible assets, but depreciation is charged only on tangible assets. If you are going to say the depreciation can be charged on intangible assets, it is considered as an amortization. So, like in patents, goodwill, trademark, the valuation of intangible assets or some amount has been deducted from it, that is considered as an amortization. So, here it is considered a depreciation. We need to strictly find out the tangible assets like machinery, building, plant, furniture, electric equipments, vehicles, etc. So, all these assets to be identified, and then we will have to apply the things. Book value fall. So, represents a continuous reduction in the accounting book value. Why it is continuous reduction accounting book value? Because of every year the usage of the assets has been deducted from the cost price of the fixed assets, and then amount of the value which has been deducted is considered as depreciation, and that is why the book value is always falling. So, now suppose if you purchase on the year in the year 2026 of rupees 5 lakh of assets, then first year you have to charge the depreciation on 25-26, 31st March 26, then the amount of depreciation deducted, the book value is actually reduced. So, next year the amount of the balance of the assets will be transferred into the balance sheet. The next year again the depreciation will be charged on cost price. Cost price, it means 5 lakh. Cost price means 5 lakh. So, depreciation will be charged on this amount, but it will be deducted from the book value. So, what was the book value? After the depreciated value, the what was the value, that is considered a book value, and you have to deducted the depreciation from the book value. Charge on cost price deducted from the book value, and balance will be carried forward into the next year balance sheet as an opening balance. So, that is why it is considered the book value fall. Then utility decrease naturally. As the book value is fall, utility is also decreases because of efficiency, and the strength of the assets is also gradually decrease because of the usage it decrease. So, reflects decline in operational efficiency and service capacity, it decreasing. That is why its utility decrease. Absolutely non-cash item. This is non-cash expenses. Why it's non-cash expenses? Because of when you purchase an assets, at that point of time you spend 5 lakh rupees. So, if the 5 lakh rupees were already spent in the year where you purchased and it has been already deducted from the cash or bank balance. Now onwards, only the amount of usage or a amount of assets utilized in the specific year or a proportion of the value of assets has been utilized in the specific year was deducted from the book value. That is only the deduction from the assets and transferred from the profit and loss account as an expense deducted, considered from the revenue, considered as a non-cash items, where we are not paying any amount to the third party, that is depreciation. So, depreciation is just an internal arrangement of the valuation of assets, efficiency, reduction, consider at the partially the amount of assets utilized in the business to match with the current year revenue, debited the current year proportionate expenses of the assets. That is why this valuation is considered as a non-cash item. So, there is no any cash payment or no any bank payment made during the charge of a depreciation. It is purely internal adjustments. The adjustments entry is also very clear. Depreciation account debited to fixed assets account. Depreciation will be transferred into the profit and loss account. So, write down in the profit and loss account debit side as a depreciation, and in the balance sheet depreciation deducted from the fixed assets. So, there is no cash goes out or cash comes in the business for this specific entry. So, that is why it is considered a non-cash expenses. Next is allocations versus valuation. Allocations versus valuation, very clear. It is cost allocation, very simple. The systematic allocation of expired cost over the useful life. I told you in the previous slide that 5 lakh rupees of the assets, usage is 15 years. So, what you have to do it? 15 years has to be considered to division with the 5 lakh rupees, whatever the amount it comes, that amount is actually considered as a depreciation. So, systematic allocation of expired cost value over the useful life, that is considered. In case of if the any other feature or factors were not given in this particular example. In case of if the any the further adjustments or a feature has been added, then we have to apply those things also. Next is not market valuation, very clear, does not attempt to measure real time the market value. Market value may be differ. So, that means you can't use the market value of the assets to calculate the depreciation. The depreciation will be calculated in case of a straight line method, it is always calculated on a cost price, that is clear. In case of a straight line method, the depreciation amount also remains same of their useful life. So, it can't change. In case of if the first year depreciation value is 30,000 rupees, so for all remaining 15 years the depreciation value will be remain same of 30,000 rupees only, there will be a no change. In case of a method is changed, then again the depreciation value also calculated differently. Estimate base, so that calculated using the management estimated lives also, as I told you, the another feature, here the feature add its scrap. Suppose this machinery is used for a 15 years where the 5 lakh rupees you spend, but at the end of the 15 years if the scrap value of the machinery is 50,000, if the scrap value of the machinery is 50,000, then how the depreciation will be charged? Then the depreciation will be charged in a different way. Cost price minus scrap value divided by the number of years. So, 5 lakh minus 50,000 divided by 15 years. So, 5 lakh minus 50,000 it is considered 4 lakh 50,000 divided by 15 years. So, per year depreciation value is 30,000. So, that means when estimated base it is very clear, you need to estimate that this machinery used for how many years, that is the first estimation, and the second at the end of the estimated years how much amount of the scrap value can be realized out of it. The next is internal capital retention, that is another feature, another method, conserves business funds for future replacement. After 15 years this machinery is actually already outdated, so that means it is gone, right. Now you have to replace this machinery after 15 years. So, in case of if you want to create a fund, then instead of the depreciation actually charged from the profit and loss account, you can create the depreciation fund also. So that is the internal capital retention conserves the business funds for future replacement. So that is also the another method that you can apply here. Next is primary causes of depreciation. First is physical wear and tear. Continuous usage leads to natural exhaustion and physical deterioration of the machinery. That's clear. So that means when you natural exhaustion, it's very clear that when you are using this machinery, their usage, their capacity, their efficiency, their perfection is all those things were actually gradually reduced, and that's why the deteriorated of the physical existence of the assets reduce. That was the first part, and that's why it's physical wear and tear. Passage of time, exposure to natural elements, naturally due to a rain, due to a wind, or maybe a corrosion, any kind of a reasons reduces assets value. That is also possible, and that's why it's considered as a passage of time. Obsolescence, that is naturally, suppose if you purchase one asset in year 2020, but due to the innovation, due to some AI technology, or due to some new technology, you find out in the year 2026-27 some advanced technology machineries were actually comes in front of you, which actually provide you a better output, better efficiency, and it will be usage in the company also for a longer duration. So what your decision? The decision might be that old machinery which is already using by right now may be considered as an obsolescence of the requirement, or as per the market demand, or as per the company demand, or as per the production capacity utilization demand. You might change that actually from the old machinery to ship the new machinery. That also consider that the technological innovations, that also possible the machinery change. So that is also considered as a part of depreciation. Depletion and right expirations, natural resources exhaust via extraction, legal rights expire over the contract terms. Naturally, because of due to the extraction of the assets, or maybe usage of that machinery, that particular usage will be over after a certain period of time. Also it's considered the part of the depreciation. Or maybe you have a contract period also, that contract period is also over, would be considered the part of depreciation. Maybe some period of time you might hire the assets for a specific period. After the contract over, that the particular assets can utilize value will be automatically zero, or maybe near to zero. That considered as a part of depreciation. Moving to the next point, here the objectives of providing depreciation. Fine. First is ascertain the true profit. Correct. Why ascertain the true profit? Because of the depreciation is non-cash item is exactly correct. But as already mentioned since the first slide or introduction of the unit, that the depreciation is actually the item of expenses which has been incurred in the initial year, or maybe the first year when it was purchased. Actually, instead of the recording the whole amount as an expense against the revenue generation, would be not a right accounting transaction, and that's why we need to identify the actual usage of the asset on a specific period to identify or matching the cost against the revenue. That's why we consider the amount of depreciation on the specific year would be debited on the respected year to identify actual profit or a true profit. So matches an expired assets cost against the revenue earned to present a true and fair operational result. True financial position, again, why true financial position? Because of, as I mentioned you, the assets when you purchase it is always recorded in the balance sheet, but that is recorded as a cost price in the first year of the assets purchase. Gradually, when you use these assets, the depreciation write-off from the profit and loss account, the same amount of depreciation reduction and reduce from the balance of the assets, and remaining balance will be carried forward into the next year. So it is considered as a book value of the assets or a machinery or a fixed assets will be showing in the in the balance sheet. So, prevent overstatement of an assets by reflecting net accumulated value. Then it is another method, you can create a depreciation fund, then you can reduce the assets on the one side and create a depreciation fund on the other side. That also the another method to write the depreciation instead of writing a depreciation in the profit and loss account. Next is keep capital intact, correct. Accumulates internal funds year after year, the seamlessly replace the discarded assets, correct. So, what we are going to do it, we will chart the depreciation on one hand, simultaneously we create an fund also on the other hand. So, after the 15-year when the assets become a zero, other side your reserve fund has been created to buy a new assets and you can replace the older one. So, when you discarded your old assets, you can replace the new assets when you have create the another method, that's fund depreciation fund has been created against this particular. Charge against the revenue profit, mandatory charge, that's create. Mandatory charge means depreciation must be provided whether the entity makes a profit or a loss. So, it is mandatory. Whenever you charge the depreciation, depreciation has to be debited in the profit and loss account, and it has been debited whether you earn a profit or a loss, but it necessary or it must to record in the profit and loss account. Matching principle, it's very clear, the amount of revenue which you are actually earning, the same year the what you earn a revenue, that for earning a revenue whatever the assets utilize for earning a revenue, the same amount of proportion or same amount of cost value of the assets has to be debited against the revenue. Why? Because of due to the matching principle that fixed assets acquisition cost must be matched against the revenue generated over the operational years. So, in the specific year or an accounting year. Internal retention, since no external cash payment occurs, retained funds remain inside the fund. That I already mentioned in the previous slide, that is it is a non-cash item. So, ultimately it's no external cash payment occurs, only the retained funds remain inside the fund. It is just an debited as a consider as a reduction of an assets and expenses to be built up against the matching of the specific revenue earning. Statutory compliance, naturally as per the Companies Act, the depreciation mandatory has to be debited from the particular account. So, that is why Companies Act depreciation is compulsory before dividend declaration. So, if you are going to declare the dividend, the depreciation has to be charged as per the norms of the Companies Act and debited from the profit and loss account. Factors determining depreciation. Factors like, first, it has been considered as an original cost. It's a total cost including purchase price, freight duty and installation expenses incurred to make assets operational. So, all these expenses added into the purchase price of the assets and the total cost would be considered to charge a depreciation. Estimated useful life, we need to identify the expected life of the usage of the assets, that is considered the estimated useful life. Estimated residual value, we need to identify the scrap value of the machinery at the end of the useful life, that is to be deducted at the time of charging a depreciation. Obsolescence and shift intensity, that is little different because of due to the technological obsolescence and any kind of reasons of obsolescence, that time we need to identify the what amount of the differences were created, that would be transferred into the depreciation account. So, it is a multi-shift usage patterns influencing a depreciation rate. So, that time maybe the depreciation would be little higher than the actual depreciation. Now, the straight line method, under this SLM straight line method, fixed and equal amount is charged to the profit and loss account throughout the useful life. So, depreciation as per the SLM method, as I told you, depreciation will be fixed and it will be remain same for their useful life, there will be a no change. Assets book value steadily decline until the reaches zero along with this estimated scrap value because of its given. So, ultimately every year the depreciation value will be deducted from the book value of the assets and gradually it becomes almost zero to consider as a scrap value. So there are two methods to chart the depreciation. It's a formula. Annual depreciation amount, one is depreciation is equal to cost price minus scrap value divided by the number of years. Cost price is 5 lakh, 50,000 is a scrap value, 15 years is number of useful life, depreciation will be 30,000 in case of if the example is like that. Rate of the depreciation is 30,000 depreciation value, cost price is 5 lakh minus the scrap value is 50,000 into 100. The rate of interest automatically you will find out that is 15 years, 15% or 15 years, because of here the rate of interest is to be find out, but in case of this method rate of interest would not be there. But if you want to find out the rate of interest, this is the formula, depreciation divided by cost price into 100. Now this is the example. I'll tell you how this example will be prepared. Mansi Limited has purchased a machine of rupees 48,000 on 1/4/2023. Installation expenses of the machine is 2,000. So that price has to be added into this, as I mentioned in the previous slide. The estimated life of this machine is 10 years, right? And scrap value of the machine is expected to be 10,000. So we have all the values. First, what we have to do it, we have to identify the cost price. Cost price is purchase price plus installation expenses. So your cost price is 50,000. What is your scrap value? It is 10,000. So we just need to put all these values in the formula. That's 50,000. It's actually a cost price. 10,000. It's a scrap value. Number of uses is 10 years. So the depreciation amount is 4,000. Now, if you want to find out the depreciation by percentage, that depreciation is 4,000, the cost price is 50,000 into 100, 8% its depreciation rate. Okay. Now, determine the annual depreciation and annual depreciation rate under the straight line method of depreciation. So that they ask to prepare certain things. Accounting year of the company ends on 31st March. So start date is 1st April, end date is 31st March. Prepare journal entries and the machine account and depreciation account for the first 3 years and disclose the accounting effect on them. Certain journal entries are very simple. I'll tell you how it is. The first journal entry is purchasing of these assets. So what we purchase, it's machine we purchase. Machine comes in, machine account debited 48 plus 2, it's 50,000 because of 2,000 added into that. So machinery account debited 50,000 to cash and bank account 50,000 because of we purchase in cash. Right, Mansi Limited purchase. So it's purchased in cash and bank. So machinery account debited 50,000 to cash and bank account 50,000. That's first. That entry it's made on 1/4/2023. The second entry is we need to charge a depreciation. So now depreciation will be charged on which date? 31st March. So here the first entry is machine account debited 50,000 to bank account 48,000. To cash account 2,000, ultimately cash and bank account 50,000, right? The second entry at the end of the year 31st March 2024, depreciation is your expense. It's a non-cash item, but it's an expense. So depreciation account debit, and we charge the depreciation on machine. So depreciation account debit 4,000, as we have a depreciation 4,000 we just calculated in the previous slide. If you remember, yes, this is your depreciation. So 4,000 it's your depreciation account debit to machine account 4,000 rupees, and at the end same date this depreciation will be transferred to profit and loss account also. So depreciation transfer to profit and loss account same date, profit and loss account debited to depreciation account 4,000. So depreciation is a temporary account which will be closed in the last particular date, and the net effect is profit and loss account, ultimately it's transfer. Now just I'll show you how it will be posted into the account also. In the machine account debit side, because of this is debit, so machine account debit side, date is 1/4/2023, the opposite name is bank and cash, or if you are only one bank account or cash account, then you can write together 50,000 bank account, or to bank 48 or to cash 2,000 rupees. Then the depreciation was charged 4,000, so machinery account was credit, opposite name is depreciation. So in machine account credit side, last date 31st March 24, opposite name is my depreciation 4,000. So closing balance is 46,000 rupees. That is carry forward balance. Next year, this is opening balance. The 1/4/2024 balance brought down 46,000. Correct? Again, the depreciation will be remain same 4,000 because of it's a straight line method. What we have to do it now, first entry is only done for the first year. Then the remaining two entry will be continuing for the next remaining all the years till the balance of the machinery becomes 0. So here the next depreciation entry is 31st March 2025. Again depreciation account debit to machine account 4,000 and then transfer into the profit and loss account. Profit and loss account debited to depreciation account 4,000. That is for 25. Now again for 26, same entry, 31st March 26, depreciation account debit to machine account 4,000 and the same date 31st March 26, P&L account debit to depreciation account 4,000. Again it will be posted here one by one. That the first is this 31st March depreciation to machine 4,000. So posted here 31st March 25 depreciation 4,000, balance 42,000 is carry forward. So 1/4/25 balance brought down 42,000. Again last second entry depreciation to machinery by depreciation 4,000, balance carry forward 38,000. So here 1/4/2026 to balance brought down 38,000 if they asked to prepare fourth year also, but they didn't ask, they only prepared, they asked to prepare for 3 years, so we just show it here till 3 years. Now this is the depreciation account. Now we can post the depreciation entry also. 31st March 24 it's debited. So in depreciation account debit side, opposite name is machine, 31st March 2024 to machine 4,000 rupees. And the next entry, the depreciation transfer into the profit and loss account. So it's recorded in the credit side of depreciation account, 31st March 24 by P&L account 4,000. Depreciation account always closed, there will be a no balance at all because of whatever the depreciation we charge on assets, the same depreciation we will transfer into the profit and loss account. So at the end of the year, depreciation account will be square off. So it will be nil, there will be a no balance at all. So see all the 3 years, machine debit and P&L credit, machine debit and P&L credit. So all these balances were actually square off. This is the straight line method depreciation problem. So we discuss here the one method, that is straight line method. There are two important methods presently working in this particular scenario. One is this straight line method and the second is reducing balance method that we will discuss into the next video lecture. Thank you.